Good afternoon, everyone. Welcome to our final financial webinar of the year on tax matters. Today, we are going to have fun. It's going to be, we have a lot of experts, so I'm going to get through the ANPA stuff so we can get started. Um, People have their AI thing joining, which is okay. So the webinar is being recorded. It will be posted after the webinar. We will post it on the AMPA YouTube page and on all the WhatsApp pages. So you'll get to hear this again. Before we get started, let's just talk about what brings us here. This is a combined webinar by AMPA and AMPA Foundation. My name is Dr. Stanley Okoro. I'm the AMPA Foundation President. I'll be your moderator for today's webinar. Today is our 42nd webinar since its inception. It's 42 hours of awesome information. And we are AMPA. AMPA is the Association of Nigerian Physicians in the Americas. Is a 501(c) incorporated organization in 1995, represent over 8,000 physicians, dentists, and allied health care professionals from Nigerian birth and ethnicity. We have a lot of members benefit. You're here already because of AMPA's benefit, even though we invite some of our friends to join us because we like to share information. We have a professional CME. There is no CME for this particular webinar today. Maybe in the future. There's a lot of leadership opportunities, practice referrals, networking, support for each other, medical missions. We have our next medical mission is April 10th to 17th 2026 in Nigeria, Imo State, Nigeria. Practice management, financial education, which is what we're doing today. For those who want to get more information about AMPA, you can visit ampa.org and join that way. The webinar is also co-sponsored by AMPA Foundation. AMPA Foundation is a financial arm for AMPA. It was founded in 2022 for three main purposes: to raise funds and create financial independence for AMPA via philanthropy, estate planning, and business investments. Number two is to create sustainable system of healthcare in Nigeria and beyond. And number three is to educate AMPA members about personal and business investments, tax strategies, estate planning, multi-generational wealth, legacy, and philanthropy. That's what we're here today. We hold this webinar. It could be monthly, but when at least quarterly. It's 1 hour. This is an intentional aggregation of subject matter experts. We think this is the highest and best use of your time. It's free time for members, and we do share. Like today, we invited some of our friends from other places. The materials presented at all AMPA webinars for general education information purpose only and is solely the opinion of the presenter. No webinar is intended to provide personal, financial, or legal advice. It is left to the discretion and judgment and is the sole responsibility of each attendee to determine what's necessary for his or her practice. Neither the speaker or AMPA can be held responsible for the materials, opinion, or any inadvertent errors or omissions in the preparation or presentation of the material. Furthermore, nothing in the material should be construed as an endorsement by AMPA. Very important. Again, this is a co-sponsor webinar by AMPA and AMPA Foundation. We have award experts today. I'm going to have Amy can introduce his team. Some of them I have met before. But before we have Amy, I have a little short video to play for you guys.
Meet Amy Kanu, a visionary leader and a financial expert, helping doctors, dentists, and other healthcare professionals grow, protect, and transfer their wealth with tax planning, risk management, asset protection, and philanthropy. Providing security and peace of mind through wealth preservation and tax management. Enyi has over 30 years of experience providing his clients financial security. With accolades and recognition from prestigious institutions, Enyi has transformed how physicians manage their wealth through strategic tax planning and innovative financial solutions.
Often physicians are paid a lot of money. They also pay a lot of taxes. And that's something they're very blind to. They typically think that high taxes comes with high income. And that's not true. That's a blind spot that most of them have. And the reality is you can do something about it. We can help.
For example, without professional guidance, a physician that's earning an average of $400,000 a year over a 20-year career will pay at least $2.8 million in taxes. That's enough to do a lot of other things with, if you can redirect some of those savings, and we can help you do that.
We have specialists earning over $1 million a year. In many cases, several $1 million a year. You can imagine what their tax burden is. And in most cases, they think there's nothing they can do about it. That is not true. Your current tax preparer may not know about these legal proactive strategies in the tax code that would reduce your taxes. Our specialists would educate and work with them to meaningfully reduce your taxes, letting you keep more of what you earn. Now, as I say this, I want you to understand something. Our goal is not to get you to pay zero taxes, because if you want to pay zero taxes, there's a very simple solution: earn zero income. Our goal is to help you pay the least amount of taxes that you can and should pay legally.
With Enyi and his team of tax experts, many healthcare specialists have successfully minimized this burden, allowing them to focus more resources on their practices and personal lives. Enyi's WealthRx for Doctors offers a holistic virtual family office approach. Discover the WealthRx advantage. Reduce your tax burden, grow your wealth, and secure your financial future with confidence. Contact us today to help you restructure your financial strategies, lower your taxes, and build financial security and true wealth. Take advantage of our free second opinion and financial gap analysis. You may scan the QR code to schedule an appointment with Enyi Kanu and our team now. Talk to us. Expertise matters.
Thank you very much, Stanley. Thank you. I think I can take it from here.
Yep.
I really could not be more excited about these end-of-year tax strategies. Usually we advocate that you start early, and this is an ongoing year-round planning thing. So when we do the end-of-year tax planning, it's usually kind of a last minute. In football, it's called the 2-minute drill. So this is our 2-minute drill, my friends. And we've got an app for that. By that, I am considering NECA an app for your tax planning, okay? NECA is a CPA, one of the proactive planning experts that you will find in our ecosystem and in the relationships that we have. She's going to walk us through a number of solutions and strategies that are last minute, and particularly the big, beautiful, bad, whatever you want to call it, the OBBA as we call it, okay? Nick is going to do that. But real quickly, one thing I want to highlight here is I want you guys to pay attention to the 3 columns I have here, because I like to talk about these things because that's important. It's about the power of compounding. You can compound wealth. And in this thing here, what we're doing real simply is we're taking $1 and doubling it every year for 20 years. No taxes, my friends. You just compound it. If you double $1 for 20 years, you've got $1,048,000. If you basically wait 5 years and you 10x what you're doubling, so you start with $10. 15 years later, you're going to have $300,000, $327,000. I want to point out the importance of starting now. And if you wait another 5 years, which means that you're going to have 10 years to double, you put in $50, you end up with $51,000. This is important, my friends, okay? To understand that in order for you to get wealthy, you have to start yesterday. Since you can't start yesterday, today is the best day, the next best day for you to start. Next slide, please. And this is what today's subject matter is about. You guys are going to be in the 25, 33+% tax bracket. Here's what basically happens without the impetus and imperative of the NECAs. And by the way, we have two CPAs here today. John is a CPA also. But here's what happens without proper tax planning incorporated in what you're doing. Your $1 million from starting early, basically in your 25% tax bracket, if you're paying 25% taxes, will end up being $72,000. And if you're in the 33% tax bracket, imagine what happens. You go from $1,048,000 to $27,000. This is why it is an imperative that you employ and enjoin yourselves with proper tax planning strategies and so on. Next slide, please. NECA. I could not be more excited to have NECA basically kind of take on this responsibility of sharing solutions and strategies with you. She's a financial and tax management expert. She's an entrepreneur. She's got global experience. She's received awards and stuff like that. And my friends, she is a philanthropist. NECA, I am going to let you put on a show to end the year for our audience. So you're on, my dear.
Thank you, Enyi. Pressure, but no pressure, right? Hello, everyone. Thank you for the opportunity to share a few ideas and really just, a few ideas with the few minutes I have. I think I have about 10 or 15 minutes to go through, and I think I have about 20 something slides. Could you kind of move that, or am I able to control?
I can control for you.
Okay.
Yeah.
Okay, yes. So really the intent, when I kind of thought, okay, with the number of minutes that I have, it's really not about kind of, okay, which strategies, because there's no one size fits all, but really around bringing to you the awareness of times like this and even before times like this. When I look at tax returns of several clients, or even just speaking to not even clients, even maybe just having an initial conversation, combined taxes that probably the average physician pays, you having either 1099 or W-2, it's probably where you, for those who have state taxes, from 40 to 50 something percent of taxes as a line item. So can you imagine if you are bringing in 600,000 total, probably when it's about 300,000. And the thing is that some of them are not even aware. It's like, oh, wow, after the fact. If you had payroll or rent, you would be looking at that bottom line, that why is this so high? And then now leaving half of you, 50%, let's just say 50% of your taxes, and without even like an after the fact. So I'm going to encourage you, challenge you this time moving forward, that have a look at it, quarterly. Look at what that's, because it's a lot of money, right? And you could do many things with it beforehand. Having a conversation like this, let me put my time on, is kind of, what I call like lastminute.com, right? There's really, apart from the pressure and all that to do things, it's kind of just like low-hanging fruits. My other colleagues here who are going to talk about, we can also share things that you can do immediately. But really by Thanksgiving, really, you are not able to do much. I had a new client who came in, had one-time income of about 750,000, tax planning, that additional money came in. Some of the programs are closed. So it's now for next year. Or you may have to put down a bit more significantly. So a big ask. Yeah, you may get a few things, low-hanging fruit, but take the responsibility to be even more proactive. Yes, the year ends in December, but by Q1, so kind of asking your accountant, your tax, okay, Q1, what's the strategy around that? What Q2, right? So that by now you already know that this is what I'm going to do. And even if you cannot do anything, this is the amount I am going to pay. Because that also calls for saving of the taxes, so that you are not having to have a liability September, October of 26. You are still paying for something of 25. So that's a plug-in for the consequences of not doing tax planning. Please, can you move forward? Okay, so just 10 mistakes, expensive mistakes that cause tens of thousands. Number one, failing to plan, and kind of talked a bit about that. The wrong business entity, and I'll talk a bit more about that. Missing qualified business income. For a lot of physicians and all that, they usually don't get that, but there are ways you can plan or kind of move things around to be able to qualify for this 20% qualified business income. Missing family employment, and I will talk a bit about that, and the others. Can you, next slide? The number one mistake, failing to plan, like, yeah, there's nothing wrong, and this is one of the Supreme Court justices way back. There's nothing wrong with a strategy to avoid the payment of taxes. The IRC, Internal Revenue Code, doesn't prevent that. So it's the responsibility of every single person here to have a plan. Either you're going to, this is where I am. If I need nothing, and it's okay to do nothing, but you know that you pay about 50%. And if I did that, you will pay less. And then with that money you saved, you can now invest in several, solutions, which Amy and the others who are joined will talk more about, right? So why tax planning? I think of this an overkill. It's really what's tax planning is looking forward to minimizing your taxes, not recording it. So what happens when you're not taxing? You're just recording it. And then the end of the year, your CPA or accountant says this is the amount you have to pay, or maybe you've just paid enough and so nothing back. But you don't even know the total combination, of the taxes you're paying. So it's really around what you should do when. The when is very, very important. As I said, we have just 6 weeks to go. There's, to be honest, very little you can do. And then how you should do it. So there's more information about this here, given the time to look more or read more about this. Some of these things you should be able to do. Your home office did expenses. Are you doing that? Have you taken the Augusta rule deduction? If you're not, ask your accountant. I want to take that out. And you can even have multiple. If you have 3, 4 corporations, you can do Augusta rule and deduct that across those entities. This is tax-free income, but there's a way you have to document it and put it also on the particular tax return. Missing your car truck expenses, missing family employment, right? Wrong. So there's more information about that. Can you move to the next slide? Thank you. Yeah, I want to spend a few more minutes around this one big, beautiful tax room. This is what Trump, of course, we're fully Republican right now. So even thinking about that, when the Democrats are in power, what's the implication of that? They had this Tax Cuts and Job Act 2017, and then Trump is now Republican. Obviously, it's about paying as little taxes as possible. So I will share some highlights here for you to be aware. And as I go through, I will be kind of posing questions of what you can do concerning tax planning around that. So this was, it was brought in, Congress passed it sometime in May. Can you move forward? And so one of the things they really wanted to do was to extend some of the taxes, some of the provisions that were in when Biden, again, it's also important to kind of be aware of, when you look at those in government, some of these tax, laws and all that, and then how that affects you, right? So that's why I want to just highlight some of these things for your awareness. So they sought to extend a lot of this thing because they were about to sunset. A lot of these laws were about to sunset about now. And so that's what happened. So they increased some, and then, yeah, let's move on. So lower taxes, this was in about 2017, all the taxes were lowered in terms of, the 10% general is to remain, but you can see that the higher tax bracket is about 37% now, as opposed to 39.6%. So this ties in with your next slide. Okay, yeah, your deductions as well. So a consideration here, there is now a higher standard deduction. And what they are seeking to do is to get as many people just doing standard and not itemized, right? Because you only itemize when your standard deduction is exhausted. So this year you have about 15,750. Why am I bringing it up? For those who have kids, that is free 15,000. If you have 4 kids, 15 times 16,000 times 4 is $64,000 that you can pass income to these children. But you see, it's also important based on the entity. Because if you use an S corporation, you will pay Social Security and Medicare on that money. However, there are other entities that you can use, right, to be able to take that money tax-free. So if you are like now 39% bracket, I'm thinking also of state, right? And you now pass some income to that, you can see now tax-free 60,000. And then if you have corporation, I mentioned like the Augusta rule again, right? That's right there can be at least 70,000 that you've just shaved without any advanced tax planning strategies. So itemized, capping specific itemized deductions of offset lower. Anyway, so it's lower. The essential is more people will pay less in taxes. Next slide. So also, I talked about them wanting to extend a lot of the provisions that were in place. So child tax credit was also going to sunset, but it's now a permanent doubling. So children are able to get a tax credit of $2,000. Also, they made the non-child dependents, right? And so this is if it's not your child, but you're providing for them, you can also get that. Next slide. I'm going to whiz through this. Yeah, so a good one for those who have businesses. They also, because this had the 100% bonus depreciation had sunset, right? I believe it was like 80%. And so now it's restored. And what Section 179, meaning that you can expense your, machinery, office equipment. And then even now, they've also increased some certain improvements into, so for those maybe have qualified real estate property, right? And this is where now the cost segregation for those who don't know what cost segregation is, this is where you engage a specialist, maybe like an engineer or so, and they kind of break apart the house. So typically, a non-residential property will be about 39%, meaning that if you bought the house for $500,000, you will depreciate it over 39 years. And so that is, that's not as much. But what a cost seg will do is that they will split it up apart. What's the value of the land? What's the roof? What's the HVAC and all that? It's also important to know that at times, depending on the type of property, the benefits may not be as much as you expect, you plan. So it's also important to look at the costs versus the benefit of doing that. But for this accelerated depreciation, some of the things that they've now added, which was not, that when I talked about qualified improvements, things like your roof, HVAC. So you can imagine something that would have been depreciated for 39 years, if some of them would now be 5 years, the value of your carpets in the non-residential property and all of that, and break it down. And some of them, actually, you can even do a 179 election. So it's to try and now see how can you maximize those groups of assets that can be subject to 179 deduction. Then you can expense that. So expand, and then you can expense up to 2.5 million, and then it phases out to 4 million. That's a lot. I have some clients that would say, oh, they want to go out and buy a car. No, 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 no. You don't want to just buy things if you don't need it, right? It's some kind of thinking, okay, I want to invest in this. Okay, this is the tax benefit, right? Not just going ahead and then now incurring debt, or if you've not paid your IRS debt, then you are buying that. So you have to look at kind of things in a holistic manner. Next slide, please. Yeah, qualified business income is a good one. A lot of high-earning clients, or not clients, but high-earning taxpayers, if you don't structure this well, you are not able to get it because of the income category. And so really, and the reason why they did that was when the tax law, I'm not, the C Corp was about 37%. Can you imagine that used to be 37% at some point? That's a C Corp. Now it's 21%. So it was to give pass-through businesses ability to expense a particular percentage of this qualified business income. And the amount is up to 20% of qualified business income. So the phase out of this is 384,000 for joints. So strategies to kind of like ask, your tax preparers, how can I qualify for QBI? What do I need to do to qualify for QBI? Right? We only have like 6 weeks. So things like, you would kind of, for those who have businesses, look at your last payroll. Because, after you've done your last payroll, you can't really do much of how you can modify your income. There are also limits for certain service trades, and physicians are included, accountants are included. Next slide. Yes, so this was also meant to sunset, and it's called and when I say sunset, that's kind of like expire. This is really where maybe you're expecting a large capital gain on the sale of an asset, right? And so I believe it was the Biden administration then, you can now invest in lower income areas, and there are companies that aggregates, right? So you kind of like buy into a unit of that. So what happens? So this has also, this was extended as well. And this is actually a very good strategy for those who are looking at higher capital gains with no offsetting capital losses, right? It's also important to find the right qualified fund to be a part of. So you're able to defer the tax on gains, and it's then rolled into a qualified a QOZ. Yes, so this is another of the big beautiful bill. Again, Republicans, pay it. So you can expect, for as long as Republicans are in power, most of them want us to pay as little taxes as possible. And this is what it's about your property taxes, yeah, right? And so sales and I wrote that down with yes. Yeah, state and local tax. If you look at for those, I'm sure a lot of you are itemized, the cap was 10,000. So whether you paid property taxes or taxes, no, not properties, state taxes of 50,000 or 80,000, the maximum was 10,000. So there is now a deduction of up to 40,000. Yes, and includes residential property taxes, yes. And so this is a really good benefit, right? So again, it's important when you are looking at your return, and please take some time to look at your return, even the past one, this 2024, and look at your itemized so that you kind of know where things fall in. Don't delegate the full responsibility to your preparer, because you are the one who signs it. And we talked about that you can pay taxes of, I've seen even 55% combined of your income. So that is a good one. This self-deduction limit that has increased. Next slide, please. Estate taxes, I plug in here for estate planning, right? They've increased this as well to almost 15 million per person. For joint is even more. And so if you put your things into an estate and all of that, you are, and this is like after you've passed, right? For your heirs and all of that. So important, just putting that has also increased. And then a plug in here to consider estate planning, trusts and things like that, especially when you begin to build your assets, right? To consider having a conversation with an expert in estate planning. Even if you are not engaged now, but at least getting the knowledge about what is involved and having a plan of when to do that. Green energy, I would just say that electric vehicles has been extended. I know one of my co-panelists is going to talk about that. So in just then I will move on. I have done 17 minutes. So I will there's a new deduction for interest of loans to finance US manufactured cars. So again, this drum is by American, right? Or US American. So it's not like your Mercedes and all that. But if it's manufactured here, right, you can get a deduction on that. They've also cut tax on overtime pay as well. Next slide. What did I want to bring up here? For the state, for those who do 529, so but your income limits might be, that is like your college fund. They've expanded the eligible expenses as well. Also for startup stock, which is like kind of the qualified small business stock as well. If you have more questions about this, you can reach out to me. I can for those who are gambling, probably nobody here, but if you are, I do have one or two that do. They've cut the gambling loss deductions to 90%. Next slide. Okay, so corporate taxes, right? That's something to really be kind of looking at. And usually it's an entity in terms of entity structuring to consider. For those who are on a very high bracket, because it's 21%. So and Trump is pushing for it to be 15%. So it's worth kind of just having on your radar. Even now, when you start a business and all that, you always thought, okay, S Corp is the best and all that. But from time to time, it's important to revisit your entity structuring, because there are times when C Corp may actually be beneficial, because you're able to take even more deductions, more there's some these employee benefits, right? And so try and limit that to very, very little and pay 21, because that's still cheaper than paying if you're on the 39% bracket. So there's a whole strategy or different strategies around how can you deploy C Corp. Yes, so some common issues. I've talked about the entity structure, and I've mentioned that, and related returns. It's important. These are some of the things throughout this last year I've seen. I wanted to highlight a few. When you start up a business, right, or maybe you get your EIN, important to look at that notification that comes from the IRS. I have seen in some situations where they thought it was a personal return, but it was a partnership. And so when the IRS gets to you, you will pay your penalty, because it's either you've been filing it wrong as a personal return, or and not doing a partnership return. And a partnership return, you have to get your K1s which flow into your personal. So if you have to redo it, it means you have to change your personal return. So please, if you just set up, especially if it's you and your spouse that have you and your spouse that set up the business, those are partnership returns. Always look at the notification from the IRS. It tells you what type of return to file. Another thing to look at is about your reasonable compensation, right? How do you balance that? Have a conversation with your accountant before the end of the year, around now, so that you can move things around. It's not set in stone that you end this, that you can change your yes. Another thing is short-term rentals. How are you doing that? Because that's where you can get passive, you can use up your passive losses, right? But it's also ensuring that the entity that you have used for your short-term rental is important. Cash balance plans, important to also look at, kind of begin with the end in mind. While it's a good strategy, it doesn't work for some people, right? There are better vehicles to use, particularly when you know that your income is going to keep increasing. So if you defer this, and then in 10 years' time, you will pay even much higher taxes on that. There are other things that it's okay to pay taxes now and then enjoy use of your money, right, in subsequent years. Okay, just a few things here. IRS foreign account reporting is important. I just highlight that, please. They are clamping down on that, reporting balances over 10,000. If you have accounts in Nigeria, the UK, anywhere about outside of Nigeria, the US, do that. It's important that you do that. What I want to highlight, the penalties for not doing that, and everything is now trackable, right? So it's, don't not report. That's just a plugin for here. And they are over 10,000. If your balance is 10,000 at any point in a year. So if it's under that, you don't have to fill out this form, but you do have to say, yes, I have accounts outside the country. What else? Okay, I think that's it. Then for those who, okay, next slide. So this is, yeah. So if you have questions, I'm offering a free tax analysis. Look at your return. This email could be neck@rcncpas.com. Blessed is my executive assistant. She manages my calendar, so it may be easier to just send to her. I was going to say something about Nigeria. We're doing the tax reform right now. So for those who have like companies there, the dividends, the rate is really increasing, almost doubling. And so just be aware of that space of what's going. That's for those who have investments in Nigeria. Be aware of that so that you are not caught unawares, right? With higher tax implications. I'll stop here because of time. Thank you very much. It's a pleasure to be here. Thank you for bringing me on for the second time. And I look forward to answering any questions.
Yeah, Nneka,
Thank
thank
you
you
very
very much. You are a permanent fixture in bringing you here and there, so that's not an issue. Before I go to the next thing here, let me talk about a couple of things real quickly. The intent here is to prompt you to reason through our tagline, expertise matters. We may not all be as fluent in articulating the expertise that we have and bring, which is very differentiated. The things that Nneka has talked about today, this is expertise that has taken her, not just in the certifications, but in the experience. There is so much here. All you guys who are here, guys and girls, going to medical school alone took you time, took you quite a number of years. Becoming specialists took you an additional number of years. And then practicing medicine took you even more years. The reason I bring this up is Nneka's expertise, along with the other experts that we have in our ecosystem, is exactly the same thing. When we talk about specialists, it's about that whole idea of specialists. I'll give you an example. This whole thing here that she just talked about, my friends, it is expertise that you have to outsource. You need to find the expert that you're comfortable with and outsource this to them, because it's not going to take you, you're not going to be able to amplify your results without basically staying focused on what you do and outsourcing everything else to experts. That's one. I'll give you an example regarding the expertise that we're talking about here. Taxes. I'll use $1 million. If you're earning $1 million, and she talked about this, she alluded to this in what she was talking about. If you make $1 million in 1 year, my friends, you're going to pay maybe $300,000 to $400,000 in taxes. Okay? So you're netting $600,000, $600,000 to $700,000. If you commit to the experts 20 hours, Nneka, for example, and the rest of the ecosystem team, 20 hours in 1 year, your $300,000 to $400,000 in taxes could be reduced to $200,000 or less. Okay? Now here's the math I want you to do. If you make, and do it in your own tax, with your earnings. If you give 20 hours in 1 year, and you're able to slash your taxes by 50%, maybe more, I want you to think about how much time it took you to make all the money you made in the year, and the 20 hours tops that you would need to meet with the Nneka and our team and so on, the difference that it makes to you. If you make that kind of money on an hourly basis, then we're not adding value. But I will challenge you, if not guarantee you, that the 20 hours that you give to us in the first year would more than save you the money that you make on an hourly basis. You do the math yourself. I'm going to stop at that. I'm going to bring on Luca and John, because this is one of the strategies. Nick alluded to it a minute ago. We're going to play a video. Luca is our client, is a client experience manager with Inception Financial, which is one of the number of energy credit companies that we work with. Here's the thing, guys, because he's going to talk about this particularly. The other companies that we work with that provide energy solutions are no longer accepting investments for 2025. Inception Financial is the last for 2025 that's still accepting, and it's very limited in time. Before Lucas speaks, I'm going to play the video. We're going to play the video for you about energy credits, and then I'll have Luca talk about some things. And then also,
if you are like most people, you'd like to pay less in taxes and do more to preserve and grow your wealth, legacy, and impact. Canoe Asset Management's energy tax credit strategy empowers you to do both. How? Did you know that many property owners do not own the solar system that is sitting on their roof or the batteries that are storing their power? Most are actually owned by a third party, usually a big bank or corporation, who build and maintain the system. The property owner simply contracts with the third party to buy the electricity to power their home or business. In return, the third party receives cash from the electricity payment and generous tax benefits from the IRS. In fact, energy asset ownership is a well-documented strategy that institutional investors have been using for more than 4 decades to reduce their tax burden and generate yield. Now, working with financial specialists in our network, Canoe Asset Management is making this proven strategy available to its qualified private clients. Our turnkey approach allows you to use the same money you have been paying to the IRS and instead use those funds to purchase energy assets. We are able to save you considerable money on your taxes while also generating a favorable yield, simultaneously preserving your wealth and enriching your legacy. Allow Canoe Asset Management to show you how simple and effective this energy tax strategy can be. At Canoe Asset Management, our mission is to legally reduce your taxes, risks, and expenses, and redirect those savings into growth assets, multi-generational wealth, legacy, and philanthropic causes that are near and dear to you. We have assembled a dedicated, global award-winning team of financial and legal thought leaders and subject matter experts with over 500 years of combined experience who work collaboratively to provide advanced solutions and strategies customized to meet your specific goals and objectives. Contact us to see if you qualify. Talk to us.
Luca,
Expertise matters.
you are on, and then we'll have John also join in talking about material participation and so on.
Wonderful. Thank you, Andy. Yeah, it's nice to meet everyone. As the video just showed, what we offer is a tax saving strategy in which you'd be redirecting your the taxes that you pay on your paychecks or towards your quarterlies to purchasing solar and energy storage assets. So typically when you purchase these assets, you generate 2 kinds of tax benefits. The first being the solar tax credits and also depreciation. So typically it's about $1 into the strategy is $1.30 out in tax benefits. So the example I typically like to use is if you're paying $130,000 in taxes, instead you redirect $100,000 of your tax liability to purchasing these assets, therefore saving $30,000 on your taxes. And you and I have been working with a few clients at ANPA that have already committed to redirecting $450,000 of their tax money to saving on their taxes this year, and also roll backwards up to 3 years to recoup tax dollars that they paid in the past. So it's a great strategy. I think one major piece to it is material participation, which John, if we wouldn't mind speaking on that one.
Certainly. Thank you, Luca. And hello, nice to be here with you all. And I'd like to particularly thank NECA for your very sensible recommendations and overview survey. it really plays into the idea of the best tax planning today is an all of the above strategy. Not everything's going to work for everyone, but you still need to understand what's available, what's in the toolkit. And so NECA's presentation was excellent in that regard, that she demonstrated all of the potential opportunities for tax savings. And I second the use of the quote from Justice Rehnquist: we are not obligated to pay more than what we are legally required to pay in taxes, and that's misunderstood. That does mean we can be tax planners and strategists to help clients find that place where they are paying their optimal amount of taxes. And of course, taxes are needed to keep a society moving forward. And so it's not a nothing type strategy. This is something that is available now to you through what we do with energy, renewable energy and storage tax planning that is now part of public policy in the United States. Because after all, what is taxation but the execution of public policy? Congress decides we need to do this. We want to focus here. We want to put resources here. How do we do it? We pass tax laws, regulations, and that is how a society works. And so renewables and storage have become a very prominent pursuit, notwithstanding current circumstances. This is long-standing. I worked with the Department of Energy 25 years ago, and these were not wanted and desired goals. We had solar panels on the White House in 1979. This is not new. And so what we're doing today in 2025 is bringing to you and your clients, NECA, the opportunities to share in and participate in that in a bigger way. And so the way we do it is by structuring a business. You will structure a business, a small business, does not have to meet more than 101 hours a year to reach that material participation threshold Luca just mentioned. And what that means is you're going to be involved in this investment. And the reason for this, it's not just simply a tax planning device, it's actually reality. In the end of this year, in 6 weeks, residential solar will expire. What I mean by that, the 30% credit for a residential homeowner to take that credit for their own solar system, battery system, will expire. And so this opportunity extends that out 2 more years, at least 2 more years. Batteries can go up to 2032, and batteries are becoming more and more prominent in what we see in renewable energy strategies with homeowners. In addition, there are ways to extend that 12/31/27 deadline another year or so. That would come in the next year, some strategies and planning. But in other words, this is going to be available for 25. It's available for certain, but as Eni mentioned, and Luca, this is closing rapidly. And then in 26 and 27, full availability potentially into 28. So this is not just a one-off strategy. And that, if you happen to check the dates, potentially a new administration, we may have a re-up on some of these things that are becoming very important to our energy security, our resiliency. Our grid is 80 years old and it's suffering at times. Distributed energy, and this is by definition distributed energy, solar rooftop. So that said, the business you will then set up to hold your energy assets, you'll have to participate in that. And what does that mean? It means you're going to be involved in assessing and evaluating, setting up your entity, talking to your tax advisors, talking to your CPA. The way that you will run this business is much like you run any other business, your medical practice, if you have any other side businesses. The difference between this and real estate investment, and this is very important, real estate investment truly is passive unless you are actively involved in running a real estate business. This is not a real estate business. You are selling energy to a homeowner. You are not leasing a solar system and a battery system to a homeowner. Big difference, because now you're in operating business. And so all of the attendant things you would be doing would count toward your participation. We also provide at Inception Financial tools to assist you. Knowledge Center we have that's continuously updated with new information, new ideas. We also have a portal that helps you to accumulate and track your time, your 100 hours of participation. If you are married and you and your spouse are doing this together, you do not need to both meet the 101 hour requirement. You can do it in total. And so that's another helpful strategy when you're looking at this. You really, it doesn't work with unrelated partners, non-spousal partners rather, because of that 100-hour rule. But that is really what opens the door to this as a viable tax strategy. Luca, if we have another minute or two, could you walk through the example that we typically use just to show folks some numbers? This is the
Sure.
model with the $300,000 investment in total. And by the way, your investment might be more than one home, because typically that would be a lot for a solar project. It might be 2 or 3 or 4 or 5. That's how we get to these numbers. So it's not that we're looking for these enormous homes to put solar on. Luca, are you able to take a walk through that for folks?
Stanley, can I share my screen? Is that possible?
You're muted, Stanley.
Okay. Hold on.
If not, I'd gladly walk through it, and that might be for time the best way to do it. And so imagine this, and if you have a scratch pad, feel free to take notes. And I'll try to do this in a way. Oh, great, even better. Thank you, Stanley.
So yeah, to John's point, this is an example project. These are, again, residential solar and energy storage projects. So typically each of these projects can claim up to a 30% base investment tax credit percentage on the full price of the project. A lot of the projects that we see, so again, these are residential solar panels and battery storage units on other people's homes. You'd be the owner of these assets and generate the tax benefits off of owning those assets. Most of these assets we see have an extra 10% bump on their tax credit percentage, basically because of certain reasons. And John, if you want to go into that even further, please feel free. But the main ones being domestic content. So if the equipment is manufactured here in the United States, or also if it's in an energy community, which basically means that the government has incentivized those areas to go green or go for more renewable energy sources. So this example has a 40% tax credit attached to it. As I think the video mentioned, the homeowner, what they're getting out of this agreement with you as the owner of these assets is that they're prepaying for all of the electricity that your asset would produce, typically for a 20-year period. So there's a deposit that they prepay for that electricity. In this example, it is $200,000. I'm not sure if you guys can see my cursor here, but that homeowner deposit is $200,000. So roughly 2/3 of the price of the asset. Your contribution of redirected tax dollars would be roughly 2/3 the price of that asset. So $100,000 in this example. So the total purchase price of that asset is $300,000. That would be the amount that you'd be generating the tax credits off of. So again, in this example, it's a 40% tax credit off of $300,000 would get you $120,000 tax credit. John, I'm not sure if it would make sense for you to talk about the principal basis.
Remember that number. That's important, because now that For your $100,000, you're getting a $20,000 tax credit. And so just to conclude this part of it, because we don't want to get into the minutiae here, but because of the way the transactions work, you recognize income of the PPA, that's the power contract. You also get bonus depreciation of $240,000. So NECA, you know, we're back to 100% bonus for this year. So those offset, and you end up with a net deduction of $40,000 in addition to the $120,000 credit. If you're at a 32% tax bracket, that's about another $12,000 in tax savings. So your total savings on your $100,000 out of pocket is about $32,000. These are estimates, but that's more or less how this works. And so this looks complex, and we're sorry about that. It's trying to reduce it to something for a conversation like this, but that essentially is where you end up for your investment in your business.
Thank you very much, guys. This is the whole idea behind getting scheduled and getting something customized to you. Time is of the essence with this. I'm going to jump on to the next, and thanks, guys. I'm going to jump on to the next
And
idea, and this is about ANPA, my friends. ANPA Foundation. ANPA Foundation, our mission at the foundation is to basically generate or raise money for ANPA's mission. The video I'm going to play, John Frazier is with a partner relationship that we have that helps ANPA. We have a special relationship with them where they're actually giving a bonus to ANPA members who pursue the strategy. It's about charity, where you support ANPA. It's about foundationally giving you some foundational footing for your retirement planning or other estate planning solutions. John has been, we've done John before here. He's a financial services expert in this area, focusing on philanthropy and volunteerism and stuff like that. John, let me let you go. We'll play the video and then I'll have you chime in here.
Sure.
Are you ready to make an impact?
Annie, can you hear the video? Can you see it?
Yeah, we can hear it. Can you make the whole thing, the whole page, please? And talking about that, if you guys remember,
Is that better, Annie?
No, it's gone smaller instead.
This is it.
Okay, that's fine.
Yeah. Okay.
Can't hear anything now.
Are you ready to make an impact?
Okay, good.
By establishing a charitable legacy plan for yourself with $125,000 in cash, annuities, stocks, real estate, crypto, and other appreciated assets, you will support the ANPA Foundation with an immediate grant of $10,000. You'll also get a tax deduction and a guaranteed immediate or deferred income stream for 10, 15, or 20 years to use as you choose. You can use this guaranteed income stream for your lifestyle today, for retirement in the future, or to leverage and enhance your estate, cementing your financial security and legacy. Your charitable legacy plan with $250,000 will create an immediate gift from you to ANPA of $20,000, while creating a tax deduction and a guaranteed income stream for you and your family. Of course, you can establish your charitable legacy plan with any amount you choose, but not less than $62,500. Let us create a customized illustration for you to show you how your current savings or appreciated assets can be amplified to give you a guaranteed income stream, a tax deduction, and a donation to ANPA. Here's how your charitable legacy plan could translate hypothetically into benefits for you and a gift to ANPA. An actual customized illustration and plan would be created for you personally. For example, with your personalized plan of $125,000, you will make an immediate donation of $10,000 today to ANPA. If you choose to receive income immediately, A 15-year payout offers you an annual income close to $9,000 and potential income tax deduction of over $34,000. If you prefer to defer and gain more, a 5-year deferred income plan stretched over 15 years could give you an annual income over $10,000 and a tax deduction over $43,000. With your charitable legacy plan, there is no limit to how much you can contribute. You get an immediate tax deduction just like a 401k or IRA. Donate to the ANPA Foundation and other ANPA projects. To get started, scan the QR code or contact the ANPA Foundation or ANPA leadership. You can also call 513-769-2700 for assistance.
John, thank you very much. John, if you want to add a few comments to this, to talk about the strategy and the timing for 2025, that would be terrific, especially as this is a terrific solution for 401ks or tax deferred plans and so on. Go ahead, my friend.
Well, welcome everybody. Thank you everybody for being here today. I was just looking at my calendar and literally we have 45 days left in the year. Hard to believe. And with the holidays and all that, it's going to be a little bit less than that. So it's important to understand that, first of all, Legacy Tree Foundation is a 501c3 charity ourselves. Our mission is to give write checks to other charities. That's what we do. So we work in this area of charitable giving strategies to help folks like yourself, save money on taxes, set up an income stream for, now or down the road for retirement or for beneficiaries, and also again, grant money back to ANPA or, that can help them as well. But we're a charity, we're a nonprofit, we're not a for-profit. We don't do anything that requires any age restrictions or underwriting or anything like that. So, anybody can do a plan with us if they have assets they'd like to transfer into us. And as the video said, we work with cash, annuities, securities, real estate, and crypto in a non-qualified manner. Okay, it has to be non-qualified assets to transfer with us. Now, the nice thing about what we do is that everything is simple and everything is easy and everything is quick. There are no trusts involved. There are no fees involved that we would charge you. And literally, as long as the paperwork and the asset is dated on or before December 31st, it will count for 2025, period. Even if it gets in our office in January, as long as everything is dated December 31st or before, it will be fine for 2025. You will get your tax deduction and we'll set everything up for 2025. So there's plenty of time. From my point of view, I mean, New Year's Eve is on a Wednesday this year, as Christmas Eve is. Am I going to be working New Year's Eve? You betcha. So do I want to work on New Year's Eve? No. So if you want to do it a little sooner, that's fine with me, but we're okay if you want to, if we want to do something New Year's Eve, like I said, as long as it's dated, postmarked by December 31st, everything will be fine. So any questions on anything that you have seen that you'd like my help with while we're on here? I think we have a few.
So what we'll do is let's two things. You've got a couple of options. You can go basically scan the QR codes and check off any of the interests that you have, from an expertise standpoint. That's what we will do, John, just in the interest of time.
Sure.
Let's dive into the next one. It's a 5-year retirement plan. This is something a lot of people are not familiar with, and it's a strategy where basically you can fund your retirement or fund a component of your retirement tax-free over 5 years using some, advanced solutions.
We often tally up our expenses like our mortgage, car payments, or tuition, but the truth is taxes are likely your largest lifetime expense. Consider someone with an annual income of $400,000. Between the ages of 45 and 65, they'll pay a staggering $2.8 million in taxes, greatly diminishing their wealth and ability to secure financial freedom. And with tax rates potentially on the rise, the future could hold even more fiscal uncertainty. Yet, there's a strategy that works towards reaccumulating the value of those lost dollars. Saving is essential, but it's not the end game. We're about amplifying your earnings and helping you recreate what taxes have taken. Welcome to the Kanu 5-year retirement plan. With the Kanu 5-year retirement strategy, our $400,000 earner could contribute $65,000 annually for 5 years and potentially earn the entire $2.8 million tax-free through the use of policy loans. But there's even more to offer. By using this strategy, you can also enjoy dual benefits of living and death benefit. Skeptical because it sounds too good to be true? The proof is in the pudding. Banks have loaned billions of dollars over the last decade because they work. So, how does this strategy work? Your contributions are paired with bank lending, effectively tripling your funds while sidestepping the typical risks associated with borrowing. Your initial payments are complemented by bank funds for 5 years, using your contribution as collateral. Our specialists partner with some of the largest life insurance providers to garner lender confidence, eliminating the need for credit checks, collateral, or personal guarantees. Remarkably, you bear no personal liability for the loan outside of your policy contributions. A fraction of your premium covers policy expenses, which afford protection against terminal or chronic illness and provide for your family after you're gone. The rest? It's working hard, earning interest, potentially growing with the market, yet shielded from downturns by the guaranteed 0% floor, safeguarding your contributions from market loss. Around year 15, the bank loan is settled and the cash value of your policy is yours. Recreate what taxes have taken with the Kanu 5-year retirement plan. More money, more protection, more confidence. At Kanu Asset Management, our mission is to legally reduce your taxes, risks, and expenses, and redirect those savings into growth assets, multi-generational wealth, legacy, and philanthropic causes that are near and dear to you. We have assembled a dedicated, global award-winning team of financial and legal thought leaders and subject matter experts with over 500 years of combined experience who work collaboratively to provide advanced solutions and strategies customized to your specific
How's it going?
objectives.
Another
You may
day.
also contact us by social media, email, or via call for a free consultation. Talk to us. Expertise matters.
So my friends, listen, you can scan the QR code and schedule to find out about these solutions and strategies. The last piece of this really kind of is a reaffirmation. Stanley, if you want to play that last video, you can, and then we'll go to questions and stuff like that, because this is foundational to your success and wealth.
There are 5 foundations of genuine success and wealth. The most basic is cash. True wealth extends far beyond cash. True wealth is about lasting value, influence, and a legacy that endures. The first foundation is credibility. Credibility isn't given, it is earned. It is forged in the rigor of consistent, verifiable actions over time. It is the bedrock upon which your reputation is built, defining who you are and what you stand for in the eyes of others. Without it, your potential remains lost. The second foundation is a credible network. Imagine needing resources you don't possess, but surrounding yourself with people who have the relevant experience, expertise, and influence, who believe in you. Your network gives you credibility by standing with and supporting you. Their support lends you their integrity and influence, opening doors. The credibility and capabilities of your network unlock opportunities far beyond your immediate reach. Access to the right people and relationships is infinitely more valuable than a simple handout. A mentor who opens doors can generate opportunities worth millions, eclipsing a small gift multiple fold. The third foundation is integrity. Integrity is the rarest, most precious commodity. Integrity is not about putting on a show when you're in the spotlight. It's about doing the right thing when you know your actions will never be revealed. It is the silent testament to your true character. The fourth foundation is character. How does character differ from integrity? Character is the unshakable foundation of your life's work. A crack in the wall can be patched, but a flaw in the foundation demands reconstruction. Character is unwavering. It's a constant beacon against the tides of temptation and adversity. It is the essence of true leadership and wealth. Those with unyielding character are destined to create lasting wealth, and the journey is never easy. The fifth foundation is competence. Passion is vital, but without mastery of your craft, it's a spark without fuel. Competence requires continuous learning, dedicated practice, and the guidance of experienced mentors. It is the ability to transform vision into reality. So, cash is merely the illusion of wealth. Anyone who amasses riches without cultivating these 5 fundamental imperatives, credibility, relationships, integrity, character, and competence, has likely acquired it through shortcuts and compromise. True wealth is earned through the genuine exchange of value. If wealth exists without these contributory elements, it has been taken, not earned. True wealth and financial success is about character, value delivered, and legacy. Thank you.
Thank you very much, my friend. Stanley, I'm going to turn this over to you, and then we can ask questions and next steps for those who would like to take the next steps.
Thank you very much, Amy. What a wonderful presentation, a lot of information here. So I'm going to take the moderator privilege and asking the first question. So many of our members are employed physicians, and as I'm listening to this, majority of these tax strategies seem to appear towards those who own their own business, sort of self-employed physicians or people that have business. So how does an employed physician take advantage of these kind of these benefits? Anyone can answer, but I would like to have I want Nick to chime in. I want John and Luca to chime in as well. And John, I think I want to know from the 5 presenters, how do you think an employed physician would take advantage of all of this stuff? Now, you don't have all day. We are way past our time, but this is so important that I'm going to use the moderator privilege to extend our hour. Normally, this is 1 hour. So these are called hot topics. Get to the point. Next person. So, Luca, it looks like you're ready to go. Go ahead.
Yeah, thanks, Dan. We have plenty of clients that are W-2 employees, and instead of basically withholding on their paychecks, and if John, I know we want to be brief here, but instead of withholding on their paychecks, they work with their CPA to reduce their withholdings, and instead redirect those tax dollars to purchasing the solar and energy storage assets, typically about each quarter, and then they can do that throughout the year, and basically not have to pay a larger check towards the end of the year. So it's a very common strategy for a lot of our W-2 clients, basically just to kind of do either monthly or quarterly and still get those great savings.
Okay, thank you. Luca, I'm glad you get to the point. John Fraser, you next.
Yeah, same here. We work with a lot of W-2 as well, as S Corp and LLCs. So it's just a matter of having the assets, they maybe have them in a savings account getting 0.005% or something like that, and put that money, that lazy money, we call it, to better work for them, to help them with their tax savings and structure and income for later on in life.
Nick and John, you can chime in, please, with strategies beyond what they've talked about that are specific, product specific.
John Cabral.
Yes.
Neka will go last.
Okay, good. Okay.
All right. So to quickly follow on Luca's description of how we work, the idea is to literally take someone who would not traditionally have access to solar tax credits. This is something that large institutions, banks, corporations have been using for many years. And so IRA, which came out a few years ago, sort of democratized the access to monetization of credits. This is the next step to that by allowing a taxpayer to take an investment in a project. If they're operating it like a business, that's very key. That is almost like I'll call it a gig economy type of job, a side hustle type of thing that's done on the side of their W-2 employment that would allow them, if they spend enough time, Stanley, to qualify as a business owner taking these tax advantages, which is part of a very essential part of our strategy.
Thank you. And I would like, Neka, can you put it together? How can an employee physician
So
W-2?
regardless of the vehicle, so what I've talked about is either a product or service, right? You have to think how you save on taxes as a W-2 is that you have a fixed W-2. So the items you're trying to increase are your items 12, increasing itemized deductions, or having an additional line item where you declare a loss, which is an entity. So with any of all of these vehicles that my co-panelists have talked about, is actually creating another entity through which you can pass through. It is now which of these ones work for you.
Thank you very much. I'm going to open up for questions. Anyone, the rules are you can raise your hand. I will recognize you. If you're shy, you can type your question or comment on the chat, or you can message me personally. So, anyone have any particular questions to ask any of our panelists? Yeah, the floor is open now. I don't see any hands raised. It's either you guys did a wonderful job or you just confused the heck out of a bunch of doctors. Okay, somebody raise a hand.
Little bit of
Thank
both.
you. Thank you, thank you, thank you. Go ahead. Oladapo. You have to unmute yourself. Oladapo.
Yeah. You know about Excite Capital?
Yes.
Yeah. So investing in a company like that where you contribute a certain amount of money for real estate, under what category does that come? And what kind of paper do you get to get tax deduction?
So you're asking Excite Capital, one of my friends and partners in terms of real estate investment in multi-family housing. That's what you're asking, correct?
Yes.
So
Yes.
you're asking how does that benefit you in terms of your taxes? Is that what you're asking?
Yes, and what kind of document? Because I understand that comes under the big, beautiful bill. So what kind of document do you need to get deduction, and how does it work out? Depreciation and things like that.
If I hear you clearly, what you are asking, you have invested something in a larger syndicate, for example.
Yes.
So what has happened is that you are now a partner in that. What you will then get is a K1.
I'm not necessarily a partner, but because they have
You are
Yeah,
a
you may be a
limited
limited
you're
partner.
a limited
They are
partner.
still entities.
Okay.
You also have to think of which vehicle is it, that's why that EIN, when you set up, you are part of an entity. It's
Okay.
either you're a partnership, you're a corporation, or an S corp. So you're a limited partner in this syndication. At the end of the year, you will get a K1, which is the share of income or share of losses, and they have multiple boxes. So it's with that K1 that you would apply. And, depending on how there might be that passive loss rules, so things like that, you have to probably ask. Those are kind of questions you need to ask those who have put that together.
So I'm very familiar with what he's asking. I invest in that. You will get a K1 at the end of the year, and that you will use for your taxes.
Yeah.
There is a question on the chat. Can you, I guess this applies to everybody. What can I can I start any of these tax saving strategies now before the end of the year? I guess that's why we're putting this together, correct? But
Correct. That's
let's
correct.
see do.
Yes, there are still a few strategies that you can use at this 89th or 90th hour. And that's the reason we're doing this.
So all you have to do is you can scan any of the multiple QR codes. You can scan the one on the screen right now. If you're on your cell phone, you can do a screenshot and you can scan it later. If you have a smartphone, if you hold it, it will actually take you to the if you do a screenshot and then put your finger on it, you should work. Let me see. Okay. Any other questions? Anything else? Anything else? I don't see any other hands raised. Any last minute comment by anybody before we end this? Wonderful.
Yeah.
Remember, this is
Let me-
being recorded. I'm going to post it on the ANPA YouTube page and other ANPA assets so other people can watch it as well. Any, do you have any last minute comment?
Yes. Thank you very much, everyone that has basically stayed on and listened to this at this time. I would imagine that something would resonate with each and everybody here in some form or the other. Encourage you not to try to do it yourself. Talk to some experts that you have trust and confidence in. If you want to use us as a resource, Neckar is a CPA, John is a CPA, John Caprell is a CPA, John Frazier can help with other strategies, and Luca can help with other strategies. We have all the solutions and strategies that would be of interest as you try to contemplate what's best for you. This is about you. So thank you very much for listening and indulging us, and we'll see you next time.
All right. Thank you very much, everyone. Thank you for NECA for spending your time with us this afternoon. The two Johns, I appreciate John Fraser. AMPA appreciates your donation was it this year or last year? Time flies so much.
This
It was
year.
this year. It was this year. Thank you. I'm looking forward to another donation next year. So, once you give, we expect more.
We're stuck forever, aren't we now?
That's right. That's how it is. So, and we're looking forward to donations from other people. But John and Luca, thank you for sharing your information with us. I'm assuming anyone who's interested could scan this QR code, and that's how they will get it through.
That's correct.
Yeah. Okay. That's it. All right. Have a wonderful weekend, everyone, and I look forward to connecting with everyone soon.
Happy Thanksgiving, everybody.
Happy Thanksgiving. That's next weekend,
Thank
isn't it?
you.
Next
Bye,
week, yeah.
everyone. Thank you.
All
Bye.
right. Bye-bye.
Thank you, everyone.
Thank you, everyone.